Hey guys, I'm here with my friend Andrew, my tax accountant, tax strategist. He's going to go over with us about how entities can help you save money on paying your taxes, and also how real estate can help you save taxes. So my whole team here is on commissions, so I want them to learn and see how they can pay less in taxes every year, and also for me as well. Now that we're getting into real estate, we want to learn how we can buy properties to help reduce our tax bill. So that being said, he's here to teach me and the whole company how we can save some money.
Sweet. Thanks, Jeddah. I appreciate it. Guys, my name is Andrew Hernandez. I'm a tax accountant, tax strategist. So basically, I help my clients save on taxes, but also strategize in terms of legal structure, entity structure. And this all sounds really, really boring. But think about it this way. You know, if you're new into the wholesaling game, or if you're an experienced wholesaler in real estate, you're gonna know very, very fast the difference between a W-2 and commission-based pay, 1099s, right? Very, very different. I think we need to start there, first of all, because, you know, what is commission? What does it mean to be a 1099? What does it mean to be a W-2? A lot of us have been on W-2. We have an employer, they take our taxes out every single paycheck, and this is where, you know, we get our first paycheck, we kind of look at it like, what the heck, we're getting robbed. Now I know what my parents have been talking about since I was a kid, right? I make 800 bucks, maybe they take 200 out, I get a net check of $600. When you're commission based, you close on a deal, you're getting all the money, which is great, really, really good, right? Until the end of the year, if you don't know, you could end up paying 30% of that money away. So somebody making 100 grand in commissions net, after deductions, will end up paying about $35,000. That's a lot of money, 33%. And you look at the tax brackets, you're like, I'm not even at the max. How am I being taxed this much? That's the commission-based pay trickling in. Yeah.
All right, so I mean, first of all, like I said, my whole company is basically commissions only. Okay, so I don't want them at the end of the year to have this big tax bill that they didn't know was coming. So what's a good entity they should set up? Which entity is correct for them? And what could they do now to start preparing for the end of the year to get the most deductions as possible?
And that's a good question. So the first place that we look to get immediate savings, and this is going to depend on person to person, how much you're making, net commission wise, because it's going to take a certain amount of work to form the entity and then also maintain it, not a whole ton. So the entity that we're talking about, very, very common, you would have heard it before. It's called an LLC, Limited Liability Corporation. So I recommend the LLC. It's the easiest to maintain and the fastest to set up. Now, what does this mean? It means we're gonna have a separate business. You may have a business now, just not a formal entity. We call that a disregarded entity or a DBA. We act as a sole proprietor. So an LLC is just a different type of entity setup that you've formally set up through the state. And now what we do with that is set up the correct tax designation. And that brings me to my other point. Another big reason why the LLC is so popular is because of the flexibility that you have in terms of filing structure. So what does all this mean? Let's get some numbers, right? I think that would help. So let's assume somebody's making 100 grand in commissions. Okay? There's two types of taxes that are gonna hit when you're a sole proprietor, or sole prop for short. This is if you don't have an entity, you haven't heard about it, or maybe you just haven't done it yet, right? You're making 100 grand, that's what you're gonna show on your tax return. There's two types of taxes you're gonna pay. You're gonna pay your regular federal taxes, and on top of that, you're gonna pay what's called Social Security, Medicare, or self-employed taxes. So a single person making this much, just federal taxes, would pay about 15 grand in Fed tax. Right? Add to that the self-employment tax of 15.3%. That's going to add another roughly 15K to that tax bill. Right? So you add these up, we can do easy math. I don't need a calculator for that. 30 grand off of 100 grand in commissions.
So this is with no entity?
This is with no entity.
Okay.
This is with no LLC. So you can see very, very quickly, you know, you take 30, the taxes divided by what you brought in, that's 30%. And this is truly the case. Actually, it's probably going to be a little higher than this. Yeah. So this is option one. Now, if you're making that much in commissions, you should definitely do what I'm about to show you here. Let's look at a model looking at a setup with an LLC. Great, I get with my tax guy or I get with my attorney. We make the LLC. Are we set? Everything's good? Not necessarily. The LLC is the legal structure. What's really, really important is a tax designation. And this is why the LLC is so flexible, because it can file 4 different ways. But there's one that I always recommend to my clients, whether you're in wholesaling, any commission-based pay, you can be selling Cutco knives, doesn't matter. As long as it's commission-based pay, LLC S Corp is gonna be one of the best choices. So let's look at same individual, 100 grand in net income. They're gonna have to pay the same Fed tax, right? That stays the same, 15K. But what they don't have to pay is this self-employment tax, this 15.3%. Right, so this 15.3% gets chopped down and you don't have to pay any money. So we end up walking away here with 15 grand in savings. And that's where the benefit comes with the LLC as corp election. So you can see very fast the payoff. If it's gonna take me $1,500 to make the LLC and another $1,000 to file it, $2,500, where would you rather be? Right?
So I actually have a question.
Okay.
So the LLC you can file 2 different ways. You can file as a corporation or file as self-employed as well.
Correct.
So somebody like me who's self-employed, I would not save if I open an LLC and still file as a self-employed person.
Right, because the LLC, when you first make it, actually gets taxed as disregarded. So when you first make the LLC, it's actually the same as this. So you need to tell the IRS, hey, I don't want to be treated as this, I want to be treated as an S Corp.
So would you have to pay yourself?
And that's the next thing,
Okay.
right? So you have to tell the IRS, hey, I want to be treated as an S Corp to get these benefits. Now, why am I using 100 grand as an example? I could use 50, I could use 20. The savings won't be as big because remember, we're saving percentage based. But we gotta justify the cost to form the LLC, the tax return filing fee, because now you're gonna have another tax return to file, but also the fact that you're gonna have to pay yourself on a W-2, right? When you're commission based, you have a business, right? A lot of people, you'll get your first 5, 10 grand check and you wanna take all that home. You really shouldn't, and JR obviously is gonna be able to tell you more about how to run the business and the operating expenses and all of that. And realistically, you should be paying yourself a percentage of whatever you're bringing in. That's essentially what's happening here. So off this 100 grand, we may say, hey, we need to set up a W-2 of 30K. And that's how you would pay yourself. Whatever percentage you feel like you want to pay. There's multiple ways to pay yourselves out of this entity. W-2, owner draw, or a loan. The most popular, obviously W-2, we need that to make the IRS happy. They say they want it. Owner draw is a very, very popular one, although a lot of people now are getting into loans, like JR. You can have your LLC buy yourself a property and make a loan with yourself. So you're like your own private money lender. You establish an interest rate, LLC buys property, whatever the case is, and you pay it back. And you're still getting all these savings. And everything's percentage based, so the more you make, the more you save. And that's essentially why the LLC saves money.
Okay. And another thing that's popular when people always talk about is write-offs. Right? So what's the difference with how can you write more off with the LLC?
This is the thing that surprises most people. It doesn't matter if you have an LLC, S Corp, or not, the write-offs are still the same.
Oh, really?
Yeah.
Oh, shit.
Yeah, a valid business deduction is a valid business deduction. All those Facebook posts that were saying, hey, make an LLC, with your stimulus money and put a home office in there and deduct this, No, don't do that. Don't do that. First of all, you need to have a business. Yeah, making money. I just gave you the example. Maybe not 100 grand. 50 grand is probably when it makes it worthwhile for you to jump on the LLC. But don't do it thinking that, hey, I'm going to be able to write more off, because that's not the case. A business deduction is a business deduction at the end of the day.
So you could be a sole proprietor and still write off the same as you if
Right.
you had an LLC. Wow.
Yep.
Okay, I didn't know that.
Yep.
That was a myth that you just busted.
Yeah. It's not like you get to write off more. Now, I do like them, S Corp LLCs, for a couple different reasons, just more than taxes. The second reason is audit risk. It goes down. And it's not that you're lying, and you shouldn't be lying, right? I'm still here, definitely doing something, right? But it just decreases the likelihood of you getting audited, because it sucks to go through an audit. While we don't get more write-offs, we still get those tax savings that I mentioned there. And once you get the LLC set up, right? LLC's made, you got another bank account under the EIN, you got something totally separate from you, you're paying yourself on a W-2, and you still find yourself paying a lot of money. Because it helps, but only to a certain point. You might slash your bill down by 20 grand, 30 grand, but you still might be writing some tax bills, especially if you have a lot of commissions. For example, at a certain point, the percentage does dissipate. It does, because after like 130 grand in earnings, there's really no more self-employment tax. That's just a rough number. So what happens after that? How do we reduce our taxes even more? Using write-offs. If you're in real estate, and I tell this to everybody that is an agent or that is commission-based pay, invest in holds, right? A lot of people get into the flips, or they get into, hey, thinking with that mindset, I'm just going to turn this property wholesale. Consider holding a property as a rental. And why would we want to do that? To get deductions, to get write-offs. So let me show you a quick example of what that looks like when we acquire a rental property. And it could be residential, it could be commercial, multifamily as well, anything 2 to 4 doors. The benefit will be the same, right? And if you're in real estate, it makes sense. All we're doing is holding the property and putting a tenant in there. So let's look at what happens if we buy, I don't know, what do we buy?
A single family property.
Okay.
$100,000 house. 150.
This is going to be my very good illustration. We're going to make it 3D. There you go. Put a little door. A little window.
Oh wow, it went 3D. Okay.
So we buy this very nice Monopoly house, which is an actual size representation of what you can get here in San Antonio for $100,000. But we're going to pretend that this property costs us $275,000. There's a reason for that number. It's not a random number. There's a reason for that. Because when we buy real estate, and this is another myth and another thing that surprises a lot of people, we can finance the entire property, or we can pay it cash. The deduction that we get from here is still going to be the same. Right? And why is that? Because the IRS says, hey, when I buy this property, you're going to put it on this 27.5-year depreciation schedule. So what does that mean? The IRS says you can take this piece of property that you bought, divide the cost by 27.5 years, and you take that in chunks over the useful life of the property. Now you can see the reason why I used 27.5 years for the $275,000 purchase price, because it's going to make it really easy when I divide these numbers. In this example, our depreciation deduction would be $10,000 a year for 27.5 years.
And that's dollar for dollar?
No, because you got to remember, what's our tax rate? What's our tax rate? Are we at 30%? Are we at 20%? If we're at a 20% tax rate, and 10K is the deduction, what's the savings?
Was that 2, 8?
Yeah, 2 family.
So so if you had that, you would save 2,000 on your tax bill.
Roughly.
Damn, I thought it was a lot more. So how do people? Because I always hear about people. Okay, like let's just say they made $1 million or they make all this money, and then they buy like a few single family rentals, and then their tax bill gets cut to like almost nothing. Is that just false?
No, it's not fake news. That's real news. So this is, I'll call it base, right? This is just default. This is what the IRS gives us because they want you to pay a lot of money. But there is something called cost segregation. They haven't gone after this word yet. It's probably coming, but for now we're going to call it cost segregation. So what we're doing here, we're literally, somebody's going to this property and they're looking at, okay, what are different asset types in here? And let's just look around this room. For example, the light fixtures are different than the building. The windows are different than the building. And so they're allocating that property from this number into those useful lives. Now that sounds very confusing, but we gotta remember, this depreciation schedule is only for real property, real estate. The windows and the lights have different useful lives, right? For example, fixtures and lighting will have a 5-year depreciation schedule. There's very common, you're gonna have 7-year, 15-year, and your 27.5-year if you run this cost segregation. So I'm a cost segregator and I come to this property that you own and you bought it for $275,000, you're gonna get 10,000 deduction. Or I say, hey man, you know, I studied the building, your 5-year property out of this 275, you have 30,000 in 5-year property. In 7-year property, you have 15,000. In 15-year property, you have 40,000. So 85 and the rest, the residual stays in the 27.5-year property. So what happens if we add all this up?
It's a lot.
What does it equal?
Oh, it's just 275.
It equals the purchase price. So all we're doing is we're taking this number and there's a segregator that says this is going to be out of this purchase price, we're going to allocate this much to these types of properties. Okay, now this is exciting. I know it sounds boring, but let me tell you why. Because instead of taking 10 grand deduction in that first year, you can take 100% of 5-year, 100% of 7-year, and 100% of 15-year. If you want, you don't have to, but you could. So that's 85 grand in depreciation plus 195 divided by 27. I'm just gonna throw a number. We're gonna say 7K. Wow. So total 92 grand in depreciation in year 1 versus 10 grand. And so then you take your tax rate, let's just say it's 20%.
Wow.
And I mean, I'm just gonna ballpark. 18 grand in tax reduction versus 2 grand. So this is where those.
And you used all the cost segregation tax deductions in year 1. So for this house, so you just buy another one next year because you can't use that one no more, right?
And guess what? Now you're gonna get less over time because you use a lot more up front.
Right. So you gotta buy another house
So
basically.
you gotta keep buying.
Every year another one.
But if you're in real estate and you're selling real estate, this isn't a model that's impossible to replicate year after year. You start getting into bigger buys. You can imagine if this number was 2.75 million, an apartment complex. Right, basically just add a bunch of zeros and
you pay no taxes for the rest of your life.
Yeah, and that's a model that a handful of my clients do have. They're realtors or they're wholesalers, and they've just been locking up properties. They eat rice and beans. You know how it is because they're just dumping the money into real estate holds, but they're not paying any taxes legally, right? Because that's the legal way to do it. These are the tax incentives that you get for investing in real estate. Because when you do this, you're stimulating the local economy for sure. Contractors, you're providing more housing, all that good stuff. It may not be quick cash. Your return, yeah, you could have made an extra 25K, you know, if you wholesale this or flipped it. But this is a very long-term strategy. 5-10 years, you're gonna have all that equity in that deal. You could always do a cash out refinance. Plus, you'll be getting a little bit of cash flow from the renter or the tenant that's in there. The best part about refinancing a property, taking cash out of it, it's not taxable. So.
Nice. Okay. At a cash out refi.
Yeah.
You get that tax free.
Yep.
Okay.
So let's say you bought this property and it goes to 300K, and you owe 100. You know, you wanted to take out 200, you could do that.
Wow.
And it's not taxable.
That's awesome. So a lot of people then are doing these single family rentals for this.
Right.
Because the cash flow is minimal, right? You know, $200-300.
That's right. And you gotta pick. You know, you can get that huge ROI by dumping it off, but then you got nothing after that. You also gotta balance it out with real estate.
Right.
Holds. Not a ton of cash flow, especially in single family, but you're after a more equitable play in that circumstance, especially if you're buying the property at a deep discount. Your equity stake is going to be huge, come 5 years. So not necessarily doing it for the cash flow, doing it for the taxes, and in the long run, doing it for the equity, right? That you eventually, if you want to, sell or turn around and refinance and take cash out.
Okay, I got another question. So I'm buying land right now.
Okay.
Is that, like, I'm just buying lots and I haven't built on them yet? Is that, can I write that up?
So land is not depreciable. You can't do this with land. If you get a cost segregator out there, they might be able to segregate the septic and, like, if there's a fence, but it's not worth it. Because, like, overall you're paying just for the lot.
It's only for the building.
So there needs to be a building structure. And if you start, if you haven't bought a whole property, the easiest way to get in is house hack. Right? House hack.
Okay.
Buy a house, live in it, rent out either. I mean, it doesn't even need to be a duplex anymore. They have pad split now.
Yeah.
That you can do.
So buying like duplexes, fourplexes, does that change these numbers at all, or is it just the same thing?
What changes the numbers is the purchase price.
Is the purchase price.
Right.
Okay.
So you can buy $1 million single family. That would get you the same, roughly, right, as a fourplex for $1 million.
And new construction, if you're building all out of your pocket, is that all out of write-off or no?
So we'll go back to what I said here, like whether you're paying in cash.
Okay.
Yeah, the IRS is going to look at your all-in costs when you put that property into service.
So regardless, you have to depreciate it by the 27.5.
Right. Yeah, because if you start here, you're improving, and then it's done. This is when that starts. Yeah.
So it doesn't really make sense to be cash, right? Refinance and keep building.
Leverage. I mean, it just depends on how much cash you got. What debt, what do you want your risk tolerance to be? How much debt do you want to have? It's not bad to have debt in real estate, certainly not. As long as the cash flow from the rental can clear the debt service and maybe get you a couple $100, that's good.
Okay. That makes a lot of sense. And y'all got any more questions? Because I mean, this helped me out a lot. Like, I can see the picture now. I needed it written down like this. So it's November right now.
Yeah.
Is it too late?
You got 2 months.
Is it too late to buy a house?
Now you can find properties fast.
Yeah.
So probably not.
Yeah.
You just gotta get it closed, all that good stuff.
Okay. Yeah, we can do that.
You get even close private money, refinance later. You still bought it. You still got the title.
And we can still cost segregate and all that for this year.
Yeah.
Okay, I gotta buy like 2 houses ASAP. 2-3 houses ASAP.
Buy some, multifamily.
Yeah.
It'll help get the doors up. And then it'll be one of those things you look back 5-10 years, like 10 doors, $1 million in equity.
Okay. That makes a lot of sense for me because like I didn't get this at all, but now I do. It's very clear.
Yeah, this is the thing that a lot of people in real estate don't know about, the cost segregation, but more importantly, like a lot of people that are making very heavy cash flow, they don't know that real estate can do this for them because nobody teaches it. We're just like stock market and 401k, and for me this is a lot better because I know real estate very, very well. Obviously you can see the tax benefits behind it, and then at that point you're just getting equity over time. So it's a killer move. That's why I preach this over and over and over again.
So that's why guys like Donald Trump and Grant Cardone don't pay any taxes because of this right here, what you're
Yeah,
showing us.
I know Grant Cardone, obviously heavy in apartments. He's buying apartments like crazy.
Mhm.
That's what he does.
That's why he doesn't pay taxes.
Yeah.
And Donald Trump with the commercial buildings.
That guy has everything. I mean, yeah, commercial, I mean, the jets that they have, all that stuff for write-offs.
Alright guys, well look, I hope y'all were able to understand this and it was able to be a clear picture for you of how real estate and entities can help you save on your tax bill. I know that it helped me out a lot, and I know now I need to go find about 3 properties ASAP by December so we can use this for taxes next year.
Sure.
So that being said, you want to leave them with anything?
No, thanks guys for checking it out. Of course, you can follow me on Instagram, Andrew Hernandez Tax. Just starting that, so I'll be posting clips up maybe like 1 or 2 minutes because I know it's a little lengthy. But of course, if you have any questions, you can follow me on there and always reach out.
Yep, and he is he actively practices this, so if you do need help with this, you can reach out to him and he can help you with your taxes. So that being said guys, thanks for watching, stay clutch.